So thank you for joining this webinar from Yellowstone Advisory today. We're really pleased to have Diversified Gas and Oil with us. They reported their Q3 results last week, and they're going to talk you through that today. There's a poll up on screen. If you wouldn't mind just completing that, it's just to understand the mix between shareholders and non-shareholders that we have here today. And then we'll start this presentation in a couple of moments. But just while people are arriving, just to give you a few points of administration. You're currently all on listen-only mode. Company, though, do encourage questions, and there's a Q&A box at the bottom of your screen. If you do want to ask a question, please type it into the Q&A box, and we will cover those questions at the end of the presentation. So let me just end that poll. As I think most people are coming in, we seem to have a large proportion, about 75% of attendees today are shareholders, which is good. I'm sure they'll be delighted with the performance of the company just reported. And without further ado now, I'm going to hand you over to Rusty Hutson to take you through this presentation. Rusty.
Good morning, I guess good afternoon for those in London. Appreciate everybody's time this morning. We're going to go through some updates from the trading update that we put out last week, talk a little bit about the quarter that we were very, very pleased with. Also give an overview of the U.S. natural gas macro here in the U.S. and the way we're seeing it play out over the next several months, and how that relates to us and where we're at in our hedging strategies. And then also give an overview of the recent announcement on the Oak Tree agreement, which some of you may not have been able to get information around. We'll talk a little bit about that, and then we'll open it up for questions toward the end and allow you to ask anything you would like to get across today. So with that, I'm going to start on page 3 of this presentation. We're not going to flip through a lot of these pages. A lot of this is the interims that you already have seen, but we do have some updates in here for the third quarter. But on page 3 of their presentation, which should be up on the screen right now, some of the highlights that I'd like to point out. The third quarter was an extremely challenging quarter in terms of natural gas pricing, in terms of the net back price that we receive as an operator. Some of the lowest we've seen probably in several years. The NYMEX price was weak. The basis differentials in the Appalachian and really everywhere in the country was pretty weak. So the net pricing, and we'll go over that in a second, in terms of what the net unhedged pricing would have been without our hedges. But we were still able, with our robust hedge book, we still ended the quarter with a 52% EBITDA cash margin, which I thought was outstanding with the low commodity prices that we saw. That was really attributable to a continued low-cost operation, $1.18 per MCF equivalency, or $7.10 per BOE, relatively flat with the second quarter, but very low. And we're trying to maintain that and keep consistency in that as we move forward. But that's all in, including G&A. The hedge floor for 2020, $2.76 was, as we talked, and we'll talk in a minute a little bit deeper into that, but again, was able to help prop up those prices and keep us in a very good place from a cash flow perspective. Free cash flow yield. The good news is it's come down a little bit since the second quarter, mostly because the stock price has had some re-rating and some rebound over the last several weeks. But the free cash flow yield is still strong at 25%. Low declines. We had the 9th straight quarter now of our legacy conventional production maintaining a flat production profile, which is remarkable in and of itself. I told Brad the other day, our chief operating officer, he's going to get the people used to this. They're going to think we never have any decline in the portfolio, but it's been a big part of the underpinning of not only the production of the business, but also the cash flows of the business. as we've performed over the last several quarters. 40% free cash flow dividend payout. We just announced last week, along with the trading update, another increase in our dividend, which we are very proud of. The fact that we're able to continue to be progressive with that dividend payout. So we are up, I think, 4 cents now for the one payable in March of next year, third quarter. That was a 7% increase over the last stated dividend. And doing exactly what we said we would do. We said when we do these acquisitions and we have free cash flow that's generated off these acquisitions, we'll increase the payouts, and that's exactly what we've done. So this is the first quarter that we've announced the dividend of full payouts for the 2 acquisitions we did back in May. And we continue to keep a disciplined strategy over our balance sheet, maintaining a financial leverage ratio that we're very comfortable with. It's at 2.2 as overall. But I think the important part of that is that over 70% now of that debt structure is in amortizing structures where we actually are paying principal and interest, which I have said over and over again, especially for you that hold the shares and have had meetings with us in the past. We actually believe that if you're going to leverage the business to grow it, you actually have to pay it back. And so, we're one of the few out there that's doing that. Most of these E&P companies have been content on kicking the can down the road, hoping that things get better, bullet maturities on high yield, but they just never get it paid back. And so we're in a position where we have a lot of cash flow, we're generating a lot of cash flow, and we're going to pay it back as we go. Flipping to page 4 real quickly, some of the other notables. We finished the third quarter at 107,000 BOE per day. We're still the third, for the time being, the third largest E&P company on London Stock Exchange in terms of production, at 107,000 BOE per day. We talked about the interim dividend that we just declared at 4 cents, up 7% from the second quarter, and it's up actually 14.3% in 2020. I think that's an amazing story when most of the other E&P companies and even the rest of other sectors have been cutting or eliminating dividends, period. We announced the acquisition participation agreement with Oaktree. We'll get into a little bit more specifics with that in a minute. We continue to integrate the 2 acquisitions we did in May. Both of those have been performing just as we expected. We still have some consolidation to do in terms of just backroom operations and making sure that is consolidated properly, but we're in the process of completing that. The good news is a couple of the wells on the EQT PDNP list that we had that we announced when we did the acquisitions, a couple of those wells will be going into production here in the fourth quarter, which is about 4 million a day of production. We believe once we get all of these back up and running, it could add upwards of 10 to 12 million a day of gas production. Total production that we never paid for. It's just incremental to the acquisition purchase. Hedged EBITDA of 75 million. That compares to last year at 64, and so a nice increase there. We talked about the EBITDA cash margins at 52%. The base LOE for the third quarter, another really good number, down 26% since last year, at about $7.10 per BOE, $1.18 per MCF equivalency. We talked about the free cash flow yield. We have strong liquidity at the present time at 220 million. It's actually a little higher than that now at the end of October as we continue to pay down our debt. Operations and the personnel as it relates to the 1,100 employees that we have, we've been at this point uninterrupted or not impacted by the pandemic whatsoever. We have an operation that's very rural, and most people are socially distanced on a daily basis. Market summary, a few things there. We talked about the dividend yield. It's coming down as the share price has been going up a little bit here recently. Market cap over $1 billion now. Enterprise value at 1.7. Only other thing that I would bring up on this at the present time is that, we continue to monitor the situation in Appalachia. We continue to look at acquisitions. We continue to see a lot of opportunities, both on the upstream and the midstream side. We're being very picky at this point. We're looking at a lot of things, but we want to make sure what we end up doing, number one, is the right value that has long-term value for our shareholders, and will create synergies and opportunities for us to benefit and to improve with what we're acquiring. And so we haven't done anything since May, but it doesn't mean we haven't looked at some things along the way. Flipping back to page 6 real quickly, I will go over the Oaktree agreement and talk about it real quick so that people get an understanding of what the reasoning behind it, how it impacts us, and what it allows us to do on a going forward basis. So Oaktree, that agreement was signed just a few weeks ago. Couple of things that I would note there. So Oaktree is a great partner for us. A lot of credibility in the MP sector in terms of investments and investing in the sector, both upstream and midstream to some degree. They were looking for a PDP type investment strategy and an investment that they could deploy capital into that looks a lot like us. And so as they looked out over all the opportunities that were out there, they had a lot of options. One of those options would have been to put their own management team together and go out and try to acquire assets with a new management team. But that just seemed to them to be time consuming. And why do that if there's somebody out there that's already set up to do these kind of acquisitions? So they actually approached us, and we were out looking for capital at the time, but they actually approached us. And it was clear and apparent very quickly that the strategies were aligned. And so the agreement that we worked out with them, which I believe is a win-win for both parties, really, it's $1 billion commitment from Oaktree. And they're going to invest right alongside of us in deals, not as part of Diversified, but on their own special purpose vehicle, exclusive from Diversified. So they'll put up $1 billion for acquisitions, and we'll put up $1 billion. So it'll be a 50-50 capital deployment, where we both put up 50% for the purchase price of an acquisition. However, they will promote us on the economics going forward 5%. So we put up 50-50. We actually get 52.5% of the economics on a going forward basis. They get 47.5% of the economics on a going forward basis. They're really treated just as a non-operated working interest participant. At a stated unlevered internal rate of return of 10%, once they've earned that, they will then revert back to us 15% of their 50%. So it's a reversion that after they hit a certain stated return that comes back to us regardless. So that's another. So if you're looking at it from an investor perspective, the investors, our investors, can take advantage of the promote, then also the reversion. The last thing that I would say that's a big benefit to us in this is that this creates an inventory of assets for us to acquire at a later date, up to obviously $1 billion worth of assets that we already operate, because we'll be the operator on these deals. But it gives us the ability, right of first offer. We can accelerate the reversion at any point in time, and then also buy additional interest back from them when we have a share price that we like, so that the dilution effect is lower. When we have liquidity, when we feel like it's a good time to buy now versus waiting, maybe we feel like the natural gas prices are going to go higher, whatever the reason being, but it does create an inventory for us as we move forward to be able to bring assets, additional revenue, and additional EBITDA back to the books of Diversified at a later date. So it sets up a great inventory for us to take advantage of as we move forward. I think it's a great deal, not only for Diversified, but I think it's a great deal for our investors because of the promote, the reversion aspect of it, and the ability to continue to grow the company by acquiring assets back, larger assets back from Oaktree. This also gives us the ability to do large scale asset packages. So anything under $250 million, we can continue to use and do the deals exclusively on our own. Anything over $250 million, we have to give them a right to at least look at it and make a decision on whether they want to invest in it or not. So it gives us the ability, anything over $250 million, it gives us the ability to continue to do bigger deals without stressing our balance sheet or having to raise the equity that we may not want to raise at that time. It also has given us great credibility, not only with our investors, who now can take some comfort that the business model that we've been employing now for the last 4 years is the right business model as it relates to the industry. But it also has given us a lot of credibility with the sellers of assets as they look out there and see that we have a capital partner that can put up pretty large sums of money to help us to take down bigger deals. We talked about the pipeline of future acquisitions. And then obviously we're going to have to come up with our $1 billion in those deals. Obviously, the chances of it all being at one time are not great. It could be, $300, $400, $500 million clips of deals over a period of time. But we will continue to have to raise our side of the $1 billion as we move forward. So that's really the way that the benefits of Oaktree agreement and how it plays out from a financial perspective for us going forward. With that, I'm going to stop. Eric, do you guys want to talk anything at all about the financial aspects of the quarter before we open it up for any questions from the parties on the phone?
No, I think just reminding, you did a good job speaking to the cost structure. We built the business to generate returns in any price environment, whether it's low or whether it's high. And so hedging has been a big piece of bridging the gap of low commodity prices. The nice thing, and we've got a slide that gives you a sense as to the forward curve and where, as we look out across the horizon, where prices are going, and that's on slide 16. You can see if you look back at the second half of 18, the NYMEX or the Henry Hub price was $3.27, began its downward descent to all the way down to $1.83 in the first half of this year. But as we look out, and for several of the reasons that we talked about, whether it's the lower oil prices and therefore less associated gas coming into the market, the industry consolidation that results in fewer players misbehaving, the forward curve is coming back up. And so you can see that price as we look out into the future, going all the way out to 2030, much healthier price environment. And if you further look at that in the context of slide 31, I know I'm jumping around a little bit here, but you can see the very healthy margins that we generate at these illustrative price points. So at $2.50 gas, we generate a 53% cash margin. If you fully load that with interest expense and CapEx, you're still nearly 50% at 46%, very healthy free cash flow yield, et cetera. So the business is designed to do extremely well in a low price environment or in a healthy price environment. And then certainly we've made investments throughout the year in the platform. As you know, we upgraded to the premium list in May. We've upgraded or invested in additional governance and board independence and board diversity. So we're very well positioned as we talk about this partnership with Oaktree and the opportunity set that really is generational in the United States. We certainly have positioned our platform to be very effective in rolling up assets, which is what Oaktree certainly saw as they diligenced us. And so very excited about where we're heading and the foundation from which we start.
Yeah, and I'll just end up with some macro comments. As we look out over the horizon here, there's no doubt that the natural gas macro has improved greatly since the beginning of this year. Some of the things that's contributed to that, lower oil prices obviously has contributed. The Permian has slowed down tremendously in the last 6 months, both from the pandemic and the collapse in oil prices. We've seen a significant amount of consolidation there in the last few weeks, as some of these bigger players have combined or merged, and so or bought out somebody else in the basin. All that's going to contribute to continued lower production coming out of the Permian. That's good for us because the associated natural gas that is also produced in the Permian Basin is slowly diminishing, and so we've seen a major reduction in natural gas coming out of the Permian. The other contributing factors, I believe, are the fact that even the shale players, especially in the area of our operations in Appalachia, continue to moderate growth with the drill bit. Companies like EQT, CNX have announced that they are moving towards a maintenance CapEx program, holding production steady to flat over the next several years and cash flowing their businesses, which I think is a great decision on their part. We still have some highly levered companies like Range and Southwestern and Antero that continue to drill a little bit more. But at the end of the day, everybody knows that drilling to be drilling is not going to win any of the institutional investors over. And so they're slowly moving away from the growth model. That's good for natural gas. So we've seen about a 4 to 5 BCF a day reduction in natural gas production over the last several months. We've also seen LNG pick back up to pre-pandemic levels. So as that has picked up, that means more supply or demand for natural gas. And so overall, the macro has improved greatly. You see that in the forward strip for next year, about $3.11 on average, which is great. And as we move into 2022, I think we're in the 270 range. So definitely some improvement in pricing, and we'll continue to see that. I don't think we're going to see significant amounts of rebounding occur in the drill bit. I just think that most people have gotten some capital discipline. The companies that were able to fix their balance sheets to some degree are not, real quick to want to mess that up again. So they're keeping their spending in check. We're going to continue to see more consolidation, not only in the Permian, but also in Appalachia. I think there's going to be some additional consolidation there of some of the bigger players and a reduced number of players, which means less drilling. So I think we're in a state of moderated growth. There should be some improvement in the macro, in the supply demand. We're continuing to see a lot of power generation from natural gas. So I just think we're in a much better place than we were a year ago, when most of the pressure on natural gas prices was coming really from the Permian and the people drilling like crazy down there in the oil plays and the associated natural gas with it. So we are seeing much less drill bits across the country. Some of the gas plays like the Haynesville, the Pinedale, the Piceance, those natural gas plays have really dwindled down to where there's very, very few rigs to any running. And so all of these bode very well for natural gas. And I do think that that puts us in a very good position. Now we're heavily hedged in 2021 already, but that's okay. We're going to continue to monitor 22 and 23, and that's really where our focus is. Because I've told you guys, especially our shareholders, all the time that if I'm sitting here talking about how near-term gas prices are affecting us, then I've not done my job. I need to be really focused on years 2 and 3 and farther out. And so that's really where we're at as a company right now. We have set ourselves up. If we do no acquisitions, we have targets for the next 2 years as to what, including 21. So I would say 20, 21, and 22 as to what we want to earn as a company. And we've got those targets set, and we're going to meet those targets. And that's with no growth from acquisitions. So that would be incremental. But our dividend is very, very safe. People keep asking me from time to time, why are you increasing your dividend? I said, because we can. And so as long as we can, we will. We've been very clear with our shareholders that, including me, I'm a big shareholder in the company. I'm right alongside every other shareholder, that we're going to do what we said we would do, and that is we're going to keep our balance sheet in check. We're going to take advantage of opportunities that continue to present themselves, but we're going to be fiscally sound in the way we approach those. And we're going to pay our dividends and return equity to our shareholders. And so that's the model that we employ, and that's the one that most people are now trying to get to in the U.S. So with that, I will quit talking and I will allow anybody on the phone to ask any questions.
Perfect. Eric and Rusty, thank you very much for that Q3 overview, and many congratulations on a fantastic set of results. We've had a few questions come in, but just as a reminder, if you do want to ask a question, please type it into the Q&A box at the bottom of your screen, and we'll try and cover as many of the questions as we can in the time we have allowed. So let's start with the first question. Eric, Rusty, thanks for your presentation. This question is about your recent agreement with Oaktree. It's a clever deal for you. They have an option to co-invest in deals greater than $250 million. And should we read into this that your next deals will be outside of your current Appalachian field focus, i.e. a new geography for further expansion or roll-up? And should we think as a result that you would look for an anchor deal that gives you enough scale to bolt other assets onto?
Yeah, so that's a great question. I think that the answer is yes, maybe yes. So we're continuing to look within Appalachia too. I think there's still a lot of opportunity there of deals of size. And so, you know, it takes a little longer at times to get the assets flushed out there because of the companies that we're dealing with. But I do believe that there's going to be opportunities to do some bigger deals in Appalachia at some point also. But we do continue to monitor some of these other basins. I think that there's some really, really contrarian areas of the country where people are not focused. They're never going to pick up in terms of the drill bit again, in terms of heavy drilling. And there's still a lot of different operating companies operating in those regions, and it needs to be consolidated. So we're going to look at all of those. I do believe that Oaktree gives us the advantage as we look at some of those other ones in other basins of being able to do some roll-ups strategies there also. But we're constantly looking at every area of the country. You know, we're not going to get involved in areas that are probably a little more competitive, just because we're not going to overpay for anything. But at the end of the day, we believe that there's still a lot of opportunity in Appalachia, but also some opportunities to look outside and to scale up. Most likely would be bigger deals in the other basins when the time was right.
Okay.
Yeah, I think it's worth remembering if you look at the history of Diversified, you know, having gone public just 3.5 years ago, that company represents 3% of what we are today. And so we certainly know how to step into a basin, build the relationships, establish a ground game, and then go about the process of consolidating and building that economies of scale and basically overlaying a different operating model, which is one focused on daily execution of repetitive tasks to drive costs down and improve the production from the existing asset. So I think our model is very transient, and as Rusty said, we're certainly open to looking at other areas where we think it would work well.
Okay, moving on to another question here. In the past, you've mentioned a US investor push. Aside from Oaktree, what interest have you had from other US investors?
Well, we've had a lot. We've done a lot. We've started to slowly migrate into some institutional investor marketing here in the US. We've got several meetings scheduled over the next several weeks. We're really trying to ramp up that interest level. We think that the model that we have, that the institutional investors in the US are starving for that kind of model. You know, a cash flow model, not reliant upon the drill bit, and focused on returning equity to the shareholders. And I think that's a powerful message. We need to be a little bigger to really garner the kind of attention from the US investors that we would like, but we're going to get there. And so we feel like that we've had several meetings. We've seen some some of the shareholder or institutional investors with a lot of interest. I think, there's probably a great opportunity if we ever decided to, or we needed to do a fundraise, to be able to draw on some of those U.S. investors. But we're really trying to get more of them to get, to get involved in the market on a daily basis. So that's really been the gist of our, our meetings with them.
Okay, jumping across now to an operational question. How much did it cost for you to connect the 2 EQT PDNP wells to the gathering infrastructure? And are the costs for the other 11 wells likely to be similar?
Yeah, I don't remember what the cost was. I do know the payback was like less than 6 months on these 2 that we just put in. But they're all different. So, I think the ones that we just hooked up and put in had to have some equipment on there to essentially take some of the moisture level down in the gas. They were pretty easy to hook up other than that.
Yeah, the biggest thing, I don't have those numbers either. What I'd remind is we're uniquely positioned in that our CapEx budget, including the expenditures related to that, approximate 8% of our EBITDA. So if you look last year, the investments we made in the ERP systems and other technology systems, CapEx was around 12% of EBITDA. This year it'll be 8%. And so you see, even including some of those investments that we're making and some of the assets coming online, still a very, very low element of our overall free cash flow. And it's because most of what we do in hooking up those wells and doing a little bit of the infrastructure build out is simply operating expense. So it shows up in that very low base LOE number that Rusty talked about being more than 25% lower in the last period. But the work we're doing to bring some of those other wells online will be captured in a very low CapEx budget.
Yeah, the capital expenditures to put these in line are not going to be that bad. I think some of them are pretty much obtaining pipeline right of ways and getting pipelines running, which are the biggest ones, I think.
Right.
Okay. We've had a couple of questions in about the Oaktree partnership, so I'm going to try and group these together. Firstly, how will the reversion be measured after the acquisition? And how would the reversion promote impact Diversified's financials? And finally, how do you expect the financing for Diversified's 50% part to happen?
Go ahead and answer the first two.
Yeah, so it's a very straightforward calculation. Once they've earned a 10% IRR, then 15% of their ownership reverts to us. And so if you think about, we pay typically between 2 and 4 times cash flow. So if you pick a midpoint, we pay 3 times cash flow. In about 5 years, they will have received all of their investment back. So the cash flows will have repaid their initial investment. So the next 2 to 3 years would ultimately layer in that 10% return that they need to make on that capital outlay. Once they've hit that 10% rate of return, then formulaically 15% of their, or I should say from a title perspective, 15% of their ownership reverts to us. So effectively, we then own 60% of the overall asset, or 65%, and they'll own about 35% of the overall asset in perpetuity as we move forward. So we would receive, say, 65% of the revenues associated with the asset, could pay 65% of the cost. So that's how you'd see it affect our financials moving forward. So it's certainly nice that for having made a 50% investment in an asset to in 6 or 7 years, depending on the cash flows associated with that deal, to then own 65% of that. And since these are long life, low decline assets that we target, that'll certainly contribute to the company for a very long time. And then as far as funding,
the funding side of it is, we'll continue to do funding of deals just like we've always done. Some of it could be debt, some of it could be equity. We've got partners, Community Agree, for example, who has been fantastic working with us. They're still very, very interested in doing deals with us going forward. Longer term financings, fixed coupon, principal and interest amortization. But we've got $240 million of liquidity on the RBL. We have the ability. We're one of probably less than 2 or 3 E&P companies out there where we still have banks that are wanting to come into our RBL. Most of these E&P companies are losing banks and nobody wants to get back involved. We're actually looking at, I think, maybe 5 different banks right now that are looking to get into our RBL. So we're in a much better position because of the financial situation that we're in. And so we've got the RBL, we've got debt partners like Munich Re, we've got ABS securitizations, which we're not opposed to doing more of those. And then we have the equity markets when needed.
Yeah, I'd just compliment you. We certainly have a lot of optionality across the debt and equity capital markets. I'd just remind, and I think you said about 75% of those on the call today are shareholders, so they know this well. But the threshold or the benchmark for any acquisition is that it needs to be accretive all the way down to dividends per share. So while there's no doubt that transformative growth would result in equity, it's important to remember that ultimately will read through to still a dividend per share accretion. If you go back to the very first dividend we ever paid in the first half of 2017, on a per quarter basis, it was less than 1 penny. And with the 2 consecutive raises of 7% that we've seen even during the pandemic, we're now up to 4 cents per share. So well over 4 times dividend growth that underpins the very successful equity raises we've made. So I just remind and we'll always keep the balance sheet paramount first and front and center, because we recognize that you need a strong balance sheet to be as successful in rolling up. So we will use a combination of debt and equity. We'll make sure we keep leverage low. I think you'll see us continue to use that amortizing profile, because we believe that long duration assets should have long duration financing, but it should be on a declining trajectory, so that we have that line of sight to being debt free and ultimately maintain a low leverage on the asset. So,
okay, thank you. Looking at gas prices, gas prices are over $3 now. What are your cash flow expectations for this current quarter?
Oh, so the fourth quarter, I guess, is the current quarter that we've been talking about. I think we'll end, if you look at the consensus estimates for this year, I think you'll see us meet those. I think that's around, I don't know what it is right now, about 300 million or thereabouts. So, we're very, very comfortable with the 300 million consensus estimates. And frankly, I've told our guys, 300 million next year, 300 million in 22, regardless of if we do an acquisition. So on a declining asset base, we're going to hit 300 million for the next 2 years. We're going to be very comfortable with the dividend payouts that we have, even if we did nothing. And so that's the way we're running the business. And so so cash flows are strong, and we're very comfortable with the full year consensus estimates.
Yeah, with respect to specifically the fourth quarter, we are well hedged, and so and we're hedged at around a $2.75 price. So we will give back some of that gain over $3, but that there is still a portion of our production that's unhedged, and we'll benefit from that higher price point. And we've said we're going to use hedging to provide stability to cash flow. We're willing to give up some of that upside in order to make sure that investors can see a very strong base of cash flows to bank on that dividend being there. So it will be a good quarter. We're very pleased to see a positive outlook for natural gas and strong prices rounding out the year and heading into next year. But I just keep in mind our hedge portfolio, which you do look out across the horizon.
Okay. Just to stay on that subject of hedging, the question is sort of the natural gas environment has improved in the last 6 months, benefiting, I guess, from the collapse of the oil price. Has this changed your view on hedging, on your hedging strategy at all?
No. The one thing that I've made it very clear, we're going to give up some upside from time to time, and I'm okay with that. What I'm not okay with is risking the downside. And so we want to make sure we're protecting cash flows that are necessary to operate the business, to pay down our debt, and to pay our shareholders their dividends. And so we feel like we know what those prices are that we have to protect that downside, and that's where we're focused on. And so, it's easy to stand back and say, oh, gas prices are going to go to $3 next year, or 22 or 23. So we need to just wait. But that's where people have really, really gotten in trouble. If you look at the oil guys, when the prices collapsed back in April, we saw all of a sudden the ones that were standing in the ocean, and when the waters receded, they were standing naked because they didn't have any hedges past the end of this year. And so that's a bad place to be. So we're trying to make sure that we've got a substantial amount of our production hedged out far enough where we can be very comfortable in standing here in front of our shareholders every day as we talk to them and say, guys, cash flows are good, dividend is strong, don't worry. And that's really where we want to be. So we're very comfortable. We don't change our strategies with the flow, ebbs and flows of commodity prices. Stay down the middle of the lane, and that's where you'll stay safe.
Okay, jumping across to production again. With 9 consecutive quarters of zero net declines from the legacy assets, which is already very impressive, how long do you think the smarter well management program can extend? And do you see any sign of this changing anytime soon, or do you think this could be held for another 18 months, 2 years, or even longer?
Well, I think 2 years is pretty pretty generous. But no, I do think it's, what is really occurring, because people think, well, the wells aren't declining. Well, the wells are declining. But what we've been able to do is, because we have such a vast number of wells and huge operations there, we're putting wells back in production that weren't in production. We're cleaning wells up, so we're getting wells that haven't been really maintained in quite some period of time by the other owners. We're cleaning them up, getting them back at optimal production levels. We're fixing pipelines that may be, where we're losing gas going to the sales meter and really tightening the systems up. So it's really not that the wells aren't declining. It's just that we're covering and arresting those declines with getting additional production back in. We still have a long ways to go from that perspective. So I would say that as we look out, we're playing it quarter to quarter. If every quarter we get is just like we're playing with house money. So I think that, just my discussions with Brad and what's going on in the field, I think we're going to continue to see some flat production there for a while. 2 years is probably a little optimistic, but I do believe over the next several quarters that we'll continue to see pretty flat to very, very low decline in that portfolio.
Okay. Looking at realizations, these seem pretty healthy at the moment. Could you talk about how dynamic this can be? And are we seeing the benefits of the midstream ownership now? How much of your production can you move from one market to the next in order to capture the highest realizations? Is there still a lot of room for improvement in differentials? And will we begin to see more of an impact from this in 2021?
Yeah, well, the differential question, we monitor the differentials, and what we try to do is take advantage of when we see an opportunity with differentials being, coming together a little tighter, then we take advantage and hedge. So we've been hedging a lot of those. I think we're probably have about 70% or so hedged next year of the differentials at prices that give us pretty stout margins in the business. So, I think we're going to, as we get into next year, I think we'll see better differentials that we can take advantage of. Right now, it's just that the market's a little weak there, so we've kind of pulled back. We're not really a lot of hedging on the basis side, but we already have 70% or more hedging.
Okay.
Oh yeah, the midstream business. On the midstream business side.
Are you still able to hear us?
Can you hear us okay? We keep losing you.
We can hear you.
Alex?
I can hear you. Can you hear us?
Okay, we can't hear you, Alex, but I'm assuming you can still hear us. Sorry, I don't know what happened.
Yeah, we can hear you, Rusty.
Is it muted? This is not even working.
They can hear it's David Johnson.
Okay.
We can still hear.
On the midstream side, the midstream assets continue to improve our margins pretty substantially, actually, because we're getting those third-party revenues from operators that are moving gas through our system. We're also able and working on a few projects right now to move some gas from a TECO-based pricing to East Tennessee, which is a pretty substantial margin enhancement. I think that's probably right at maybe 8 to 10% of our overall production that we're looking to move to that market. But overall, we've seen a pretty substantial pickup in the margins from owning these these pipelines. And we continue to look at some of the other pipelines that we consider to be strategic out there that we're going to take a chance or take the first opportunity when those pipelines become available to try to acquire, which will also enhance some of our and give us the ability to enhance our margins further.
Yeah, for midstream, we've always said it's about price optionality, which you highlighted. It's about flow control and being able to get our gas to market when there are system curtailments around our assets. But it's also revenue diversification. And so we talk about on page 17, there are 3 call outs next to the stack of our expenses. And we highlight the fact that if you look at the third-party revenue associated with our midstream asset, it approximates nearly $30 million a year. So if you took that $30 million that's coming to us from third parties for whom we're moving gas, and remember, we're the largest transporter on our system. So we really operate the system for ourselves and view this third-party revenue essentially as a subsidy to the system. If you offset our cost with the revenues associated with it, a fourth of our costs are paid by third parties. And so we get a 25% reduction in the transportation costs associated with our assets. So instead of paying around 50 cents per MCFE or $2 per barrel, we're able to move our gas for less to market. So it really is a great way of managing the business. We've always said it's about margins at the end of the day. So that vertical integration bodes really well. I think you've seen our peers moving back to that model. CNX recently reacquired their midstream assets after having spun them out. There was a period of time where people believed that midstream would trade at a higher multiple and therefore it created more value to strip that out and operate it independently. But that wasn't really good for your upstream business. And so they've since reacquired that asset and are managing it vertically. We certainly hold that view and have held it from the beginning. So you'll see that continue to be a focus of the business.
Guys, can you hear us still over there at the moment? Okay, bear with us a second because I'm just going to email you these questions. I don't think you can hear us currently. We've got a couple more come through and I'm just going to email them through to you.
So we're having some audio difficulty hearing Alex, but we're getting the questions sent to us by text. So one moment.
Okay, so I've just sent those questions through to you. Hopefully you've received those.
Okay, Alex will be emailing us the questions. All right, thanks, Alex. We have 4 more questions that we'll go through. So the first is, as it is election day, what are your thoughts on a possible Democrat president and Senate in terms of the fiscal impact on companies and the environment and green energy consequences?
Believe you, I've thought about that a lot. I think, as with any election, rhetoric always leads up to the election. You've seen Joe Biden flip-flop around on fracking and really flip-flop around on a lot. I'm not sure if mental capacity is fully there, but I think that if we see a Democratic president and a flip in the Senate, I do think that the biggest risks to the industry are probably around drilling on federal lands, number one, which could slow down drilling, which probably would increase prices. I think probably the biggest impact is going to, they essentially have less than 2 years because midterm elections will come up in 2 years. Most of the time they go so, they try to do so many changes that they end up losing, either the Senate or the House or both in the midterm. So whatever they try to do, it'll be quick. It will be probably, banning drilling on federal lands or making it very difficult to. Probably some additional regulations around, water, those kind of things that typically can have an impact on drilling. So I could very see a possibility of higher energy prices, which won't be good it'll be nice for us, don't get me wrong, we don't mind higher prices, but it's not good long term as a consumer will not benefit as prices will go up for natural gas, power, everything. So it won't be good for the consumer. Regulations on pipelines will probably be the biggest impact. So companies that are trying to get pipelines built, it will become very difficult. That's why, from our perspective, being vertically integrated from a pipeline perspective is very important. I think pipelines will be at a premium. And so that would be something, we have a lot of pretty much complete control over our production and where it goes. And so that's a positive for us. But overall, I think that's probably the biggest impacts. Long term, I don't see, there's a lot of rhetoric around, moving to here in the U.S. to carbon neutral, carbon free. It sounds great when they're talking about it, but at the end of the day, over, 40-some% of our power now is generated by natural gas. That's not easily replaced. And it would take a lot of time and energy and a lot of cost. A lot of cost to change that. And so I don't see that being a near-term risk here in the U.S.
All right, the next question is, how would you anticipate raising funds to participate alongside Oaktree? I think we've answered partially that. Do you pay dividends and then come to shareholders via a rights issue, which would be very tax inefficient? So I can speak to that if you'd like.
Go ahead, yeah.
But the biggest thing I'd say there is there's really no change in the strategy that we've had to growing the business all along, and we paid dividends all along the way while also raising equity. And I spoke earlier to the fact that we look at each acquisition really on a standalone basis, and that acquisition needs to be accretive to the dividend on its own merits. We recognize that there is certainly a tax consequence to raising equity and then paying a dividend. However, if you look at the industry, and there was an earlier question about further engaging the U.S. shareholder, and I think those that have been supportive along the way would agree, the industry has promised returns based on growth for much of the last decade and then failed to deliver it. And you've seen tremendous wealth destruction and value destruction through the promise of future returns. So I'm going to invest today and eventually I'll be free cash flow positive and pay you a dividend. Our belief is that each acquisition should stand on its own merits and be able to support a dividend. And so while there certainly is a tax consequence, net, the total shareholder return that investors get when they receive that dividend well offsets any tax consequence. So do you have anything else?
No, I think that's exactly right.
The next question is, what will the high gas prices do to opportunities for asset acquisitions? Will acquisitions become too expensive?
Well, no, I think, we're talking about high gas prices in the $3 range. That's still pretty darn low. As I look out over the horizon and look at what gas prices will do over the long term, I think that, we've said all along, 250 to 350 is the range bound that we look at. And if we can buy natural gas in that range, we're very comfortable with it because we're not overpaying. We're long-term players. When we look at assets and we're acquiring assets, we look at it as if we're going to be the last owner of that asset. So, from our perspective, buying natural gas at 250 to 350 is still a very, very attractive place for us. Do the acquisitions get more expensive? Depends on who the sellers are. I think we're seeing a significant amount of bankruptcy activity right now. And so as we look at that, those are typically different than if, EQTs wanting to sell assets to divest of non-core type production. So it's two different types of plays. I do think that, obviously the multiple doesn't change. It just means that you're paying more because natural gas prices are a little higher. But we address that quickly because we're hedging. And so we hedge immediately to lock in what, those gains or those the economics that we are modeling in the acquisition valuations. And so we don't play around with it. We lock it in and make sure that we're covering what gas price we need to get the economics in the deal.
And that was the last question in the one's email.
Right,
I think that was it.
Yeah, I think that's the last question that that's come through. Apologies about the sound. Not quite sure why that happened, but we managed to hear the team in the US quite clearly. If there are any questions outstanding that you would like to be answered, please email them to info@yellowstoneadvisory.com, and we'll liaise with the company and get answers for you. I'd just like to say thank you to Eric and Rusty and the team from Diversified for presenting the Q3 update today, and congratulate them for a very strong performance. I'd also just to mention that our next webinar is on the 16th of November, when we've got Brickability Chairman John Richards, who will be presenting the half-year results, which are released next week. And finally, as you leave today, there is a short survey that we'll ask you to complete. We'd really appreciate that feedback if you can give that. And thanks again for attending.